Forms of market efficiency. Abnormal returns. An abnormal return is the difference between an investment's actual performance and its expected return over a given period of time. Abnormal returns can be positive or negative, and they can be caused by chance, external events, or fraud. Abnormal returns can help investors determine risk-adjusted performance, measure the impact of events like lawsuits or buyouts on stock prices. An abnormal return is the difference between an investment's actual return and its predicted yield. It can be positive or negative and can be calculated using the formula excess return equals actual return minus expected return. The expected return is based on financial models that predict an investment's performance based on its risk. A broad index, such as the S&P 500, is often used as a benchmark to determine the expected return. Some examples of abnormal returns include positive abnormal returns. If a mutual fund earns 30% in a year where it's expected to average 10% per year, the abnormal return is 20%. Negative abnormal return. If the market performs better than an individual stock, the abnormal return will be negative. Abnormal returns provide insight into how specific events impact a stock's performance. They can also be a measure of an investor's stock picking skills or strategy. Another way to calculate an abnormal return is to compare the performance of an investment to a benchmark, again, like the S&P 500 or the Nikkei 225. For example, if a stock increases by 5% due to news, but the market only increases by 3%, the abnormal return is 2%. The cumulative abnormal return, CAR, is the sum of all abnormal returns over a period of time. In short, abnormal returns are those that surpass the expected return on the basis of risk.